You're watching Investors Guide on ET now. Thanks for staying with us. This week we're talking about UTI Master Share. Now this is India's first equity fund. 26 years ago is when it launched. Avan is here to give us an introduction into that fund before we go across to Virendra and ask him if we should be investing in it. Avan.
Launched in October 1986, UTI Master Share was India's first diversified equity scheme. The scheme is entering its 26th year of existence and is trusted by more than 6,68,000 investors. UTI Master Share is an open-ended equity diversified scheme that focuses on the large cap sector. The fund aims to provide a relatively stable and sustainable performance without tilting towards any particular sector or stock. This fund maintains a conservative portfolio with a disciplined investment strategy of investing only in fundamentally strong companies. UTI Master Share has a track record of consistent dividend distribution since its launch, irrespective of the market phases. In addition, the scheme has also rewarded its investors with 3 bonuses and 2 rights during this period. But what does this mean in terms of hard cash? If you invested 1,000 rupees in this fund when it launched, you would have 5,142 rupees today. So should you add this conservative, steady performer to your portfolio? Let's find out.
Thanks, Avan. This fund has the largest history in the markets, which means that we can go back 26 years and look at the fact that it's given dividends every year. But would you say that's enough of an argument given the competition we have in the market right now to invest in UTI Master Share?
UTI Master Share has improved dramatically in the past 3-4 years. But yes, you have superior alternatives, even from UTI and many other fund companies. So I would say that it has become an average or getting close to becoming an above average fund. It has built a very strong case in recent past very strongly, and over 3-4 years I think it has articulated its whole strategy and followed it diligently. So it has become impressive. But is it the finest choice? No. You have superior alternatives available. Yes, the history and the legacy is very impressive. The first Indian equity fund started as a closed-end fund, has given dividend every year since its start. And if you would have invested at the outset, it actually is a case study. It demonstrates the long-term case for an actively managed fund, a annualized return of 20% over the past 25 years, which is very impressive.
So what are your expectations going forward, especially for investors who've been in this fund maybe for the last 10 or 20 years? Can you tell them what you expect from this fund in the years coming?
This fund has become, it has rewarded its investors in recent years more handsomely, and the outlook looks bright. And the investors have gotten so passive with the annual dividend that they think that unless there is an emergency, they don't have to do anything about it. And I think they are being rewarded for that. I would say for an inactive passive investor, they have reason to be loyal now.
Reason there to remain loyal to the UTI Master Share. Finally, your star rating of this fund.
I would give it a 4-star based on how it is doing in very recent times. Though on a risk-adjusted basis, it is still an average fund over the past 3 and 5 years.
4 stars there for the UTI Master Share Fund on Investors Guide. Now moving on, we know the market's been making you nervous going through the emails we received from you over the last couple of weeks. And to answer some of the questions that you've asked us on what exactly is driving the Indian stock market right now and what you as an investor should do about it, we put together this report with some of the brightest minds that manage money every day on what's happening in the market and how you should react. Take a look.
Indian investors have lost over 3 lakh crore rupees since April this year. And we don't blame you for wanting to run for cover. But if you stay invested, there is money to be made, and here's how. Let's first take a look at what's causing the volatility.
The overseas situation continues to keep on changing dynamically every day, whether it's the US or the European markets. We've seen a whole spate of countries getting into the cloud, getting under the cloud in terms of default, especially in Europe. The US government is trying to make things happen, but of course that's against a lot of odds. So, when every time you see European markets and the American markets react negatively or positively, we probably see a reflection of that in our market.
And it's not just the global economy that should shoulder the blame. The situation back home isn't all peaches and cream either.
inflation is not coming under control. There is no reform process that is being, that is getting kick-started, which was expected. So these are some of the headwinds that, normally you should have expected a high growth economy to sort of show some sort of decoupling with that. That has not really happened.
The volatility index, or the VIX, which is an indicator of investor sentiment, has dropped 20% to date in this financial year, while the Nifty has lost almost 500 points since April. And unfortunately, market watchers tell us there is more pain to come.
My sense is this will continue in different degrees of intensity and moderation till about December, because that's where the European cycle kind of comes to a pause of sorts from a calendar year financial perspective. And the government also needs to kind of start getting out of this paralysis that we've been noticing on a lot of changes that are required, a lot of major policy announcements that are pending.
So what should you do now? And more importantly, how can you hedge your losses so a sell-off in the market doesn't wipe out all your savings?
When the market is trending downwards, my view is that it should be good for retail investors. Those investors who look at stocks when they are volatile often get bargains and get value. So they should keep an open mind on equities right now. Keep nibbling at what they see.
Retail investor must stay invested. There is no question. And he should stay invested through the indirect route and through an SIP. So if he has time to research, then he should go for direct equity and direct investment. But otherwise, they should certainly invest and they should go through the mutual fund route.
SIPs are the easiest way to insulate your investment from a highly volatile market. But knowing where to invest is just as important. Certain sectors are less prone to risks and deal with volatility and global jitters better than others.
Look at players like Titan, look at players like Jubilant Foodworks, look at a laundry company like Lovable or a Page Industries, look at VIP Industries. These are all very clearly companies that are running businesses where people go out and spend money and really don't kind of think too much in terms of what's going to happen tomorrow.
Bank PSUs have got really hit and the valuations are quite attractive. So there may be a case for another downward pressure on prices, but I think much of that correction has really happened. So that's one sector they could look at investing with a 2-year view.
And just the same, there are sectors you could do well to stay away from.
Metals, I tell them not to invest directly because it's really very volatile, it's very global, it's hard to understand that sector from a retail perspective. Second one is real estate stocks. I always advise them that buy real estate if you want. If you want to have exposure to real estate, go and buy real estate. But don't go through the real estate stocks.
So remember, use this opportunity to buy equity, invest systematically, and research your stocks carefully before investing. While the market might continue to seesaw, this is an opportunity for you to make money.
Alright, that's a wrap on this segment. Dhirendra, thank you so much for joining us on Investors Guide and answering all of our questions. Remember, if you have questions for Dhirendra, you can write to us on email ID at the bottom of your screen. Coming up on the other side, Subhashna Kotak will answer your questions on tax, so don't go anywhere.